Howdy there, folks, and welcome into a historic video. This might be the first video in the history of this channel, the reaction channel, where I'm going to react to 4 videos in one video. Yes, okay, all shorter clips here that I want to give my opinion on. First one up here is going to be markets will have a Santa Claus rally thanks to midterm tailwinds, said Ed Yardeni. So basically, he believes that this rally we're on in the stock market is going to continue through for the next several months, essentially. And by the way, if you aren't kind of keeping up with what's going on in the markets, as of last week at the lows, we were down almost 38% in the NASDAQ. We've come back quite a bit already. It's an awful year, okay? We're down 32%, but it's better than it was. S&P 500's come back about 5.5% since that time. The Dow's come back about 7 percentage points since that time, and the Russell has been kind of the lagger of the bunch. That one's come back about 4.1 percentage points so far, okay? After that, we got to have a little bullishness, got to have a little bearishness. Veritas, Greg Branch is still bearish on the markets. We're going to listen to what he has to say, and I'm going to give my opinion on that, okay? Then I'm looking really forward to this one. Essentially, Victoria Fernandez. She has basically half her stocks are reporting earnings this coming week, and she gives her opinion on how Microsoft earnings are going to be, Apple earnings, and various others. And I want to obviously share my opinion on that. And then the last video up here, this is extremely important one, okay? The Fed will communicate a pause on hikes in November, says Joe Terranova. And that's an important subject we got to talk about because that is something that could be definitely a market mover. Thank you, everybody that subscribed to the channel. You are a channel mover, okay? We are well over 17,000 subscribers strong now at this point in time, which blows my mind. Thank you, every single person that has subscribed to the channel. I absolutely appreciate you in a massive way. If you are somebody that's looking to join my private stock group and get access to the private Discord chats, whether that be the Palantir Discord chat, Tesla Discord chat, Meta, AMD, NVIDIA, any of the others, the chef, as well as get our weekly investor report. We started that a little over a month ago, and it's a pretty awesome report that we put out every single Friday. And you'll get access to all my course curriculums if you're looking for access to that. Basically, apply with the pinned comment down there. Alrighty, guys, let's get into this. I'm looking forward to this one.
I think we're in a trading range from the June low of 3,666. We did recently drop below that, but I think we're just kind of making another bottom here right around that level. And then in the summer, we went from all the way up to 43.05 in August 16th. Obviously, still well below the record high we had at the beginning of the year, but I think we're in that kind of range. And I think that we're going to get another Santa Claus rally, and Santa Claus rallies are particularly predictable and strong as a result of midterm elections. And it almost really doesn't matter which way the House and the Senate go.
That's true. Now, one thing, this is very important. If you're wondering, where do you know this name from? Yardeni. Well, you know that name because I pull up the Yardeni basically kind of research reports from time to time on the channel, and especially the ones that show like P metrics, forward P metrics, and things like that. And I show those quite often on the channel. I haven't as much the last few months. I need to start showing those again. They're all, as far as mid caps, small caps, they're trading at, in the past like 25 years, essentially, at pretty much the lowest values we'll have ever found in the past 25 years. We're at like multi-decade lows at this point in time, which means essentially there's massive upside for small caps and mid caps over the next few years. And I mean massive upside. Now, predicting when exactly that upside is going to come is the tricky part, right? It's like, does it start to reflect in a month from now? Is it 2 months from now, 6 months from now, a year from now? That's a hard thing to predict. But smalls and mids have an absolutely epic long-term, and we're talking multi-year run. We're not talking about like, the market, we're not talking about like smalls and mids are going to go up for like a month or two. We're talking about years of like, catching up to, let's just call it that, okay? And so that's where if you heard the Yardeni name, it's because I show that Yardeni research report from time to time on the main channel, that is.
Midterm elections, no matter what, have a tendency to be very bullish, and the Santa Claus rally just continues right for the next 3, 6, 12 months. I'll give you the data if you...
Whoa, 3, 6, 12 months. Holy smokes. We really took that one. That went way past Santa Claus, okay? Was that the Easter Bunny rally as well, and the summertime sun rally, and here in Vegas, 110-degree rally? Holy smokers, that ain't no dang jokers.
But I don't know if you want me to throw data at you.
Throw it.
This late in the afternoon on a Friday.
Yes.
Well, I mean, you're talking about a Santa Claus.
Yes, give me the data, man. I'm ready for it all, baby.
rally, but what if it's too icy and dicey because of the Fed?
Icy and
right?
dicey.
And rates are going to remain high. The Fed's going to remain hawkish, and stocks aren't going to be able to rally nearly the amount that you suggest they might be able to.
Give me the data.
Scott, I listened into your show earlier, and I heard you mention something about the possibility that the market might already be discounting all that. I think at this point, the market knows they're going to do 75 basis points in early November, and now only the market's confused about whether it's going to be 75 or 50 basis points in December. I thought it was going to be 275s, one after the other, but now the Fed's throwing some uncertainty about that. I think what the market's looking for is for a pause. I don't think they're looking for a pivot. They're looking for a pause. The Fed's been awfully aggressive,
100%.
300 basis points so far since March, another 75 basis points in early November, and I think they will go ahead with another 75 basis points in December. But I think the market knows all that, and I think the market, as we saw today, got a lift from the idea that it might be only 50 basis points, and then there might be a pause for a while. Now, the economy is doing pretty well under the circumstances when all things considered. I think one of the reasons it's doing so well is because the strong dollar looks like it should be weighing on the economy, but the dollar is strong because money is absolutely pouring in to our capital markets. Over $1.6 trillion. $1.6 trillion came into into our markets from overseas on balance over the 12 months, and that's through August. And the strong dollar is telling me money is still coming in, and that's a big positive for our economy.
Yeah, so that's interesting. Unfortunately, the judge, I don't know what the judge was doing there. He should have let Ed get to the data. Instead, we just got Ed's opinion on, if it's 75 basis points or 50 basis points, which is a lot of the opinion we hear out there. I wanted to get into the data there. Judge, do better next time, man. You usually do a good job, but come on. Ed was about to give us that data. We love the data. Give us the numbers. Give us the statistics, the probabilities, all those sorts of things. All right, next one up here. Greg Branch is still bearish on the markets. All righty.
Doing that for a better part of a year now, right, Scott?
Yeah, but why are we changing yet? Ed Yardeni said you could get 15%. Why is it head fake?
Yeah.
15% on S&P? Ho, 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 ho. Merry Christmas. Wow, that's a big number there. Okay. Greg Branch, give us a bearish case.
The roadmap that I laid out at the beginning of the year, we still haven't completed it, Scott. At the end of the day, yes, most of the Fed hikes are behind us, but we still don't have agreement, even as recently as a week ago or 2 weeks ago, on what the Fed's going to do in November. And they've all but laid out the fact that they're going to get to that 4.75 rate, if not a 5% terminal rate. I was hearing whispers of that 3 weeks ago, and now that those whispers are a little more public. The estimates are still way too high, Scott. What we saw in the third quarter, the beginning of the quarter, is that earnings expectations were about 10% growth, 9.8 to be exact. Now we're at 1.5% for the quarter. I believe that the fourth quarter, which started around 7%, now is down to around 4%, needs a similar downward revision. And think about that for a second. Next year, 2023, even if you just believe that the economy stays flat, that no further deterioration occurs from here, which we know is not the case because the actions the Fed is taking have a lag effect. But at the end of the day, even if you just believe flat, that means that 2023 earnings estimates need to come down 7 percentage points. And equities just aren't safe in the wake of those headwinds, combined with the macro global turmoil, combined with us being at the beginning of QT.
What about?
So he brings out a good point there, right? And if you missed that, or you don't know exactly what he basically meant there, essentially, is he's expecting 2023 earnings to be down, right? And he expects the market to come to that belief over, let's say, the next, 3 to 6 months. So therefore, you would assume the market has to go down by at least that amount. So let's say you expect S&P 500 earnings to be down 10%, you might think, okay, the market needs to go down another 10% because it's 10% worse than we expected, right? Which in theory works perfectly, right? But at the same time, you could have other people look at that and they say, okay, that's a down year. But the next year is going to be a nice bounce back year because you do see that many times in a recessionary year or a year where earnings are down. They many times have a very nice bounce back year the very next year where everybody says, wow, look at how these earnings have bounced back, right? Which makes the valuations have to go up considerably on stocks because then if all of a sudden, let's say earnings come in 30% better than expected in 2024, doesn't really necessarily mean the stock market has to go up 30% more, right? And so all these things kind of move a little bit, you could say there's maybe a little downside there, but it's not as perfect as 7% in earnings go down. We need the market to go down 7%. It doesn't really work like that. Like I said, in theory, it sounds great. In reality, doesn't work like that. That's just never been the way the financial markets work, and they still don't work like that to this day because you have so many different participants in the market, right, that are looking at so many various things. You have the algorithm that don't care about any of this crap, and they're just trading off of technicals and all this stuff. You got obviously all the technical traders out there that are doing their thing, right? Then you got the fundamentals folks that are so long-term focused, they might not even care, right? Then you got a bunch of the short-term Wall Street crowd. You got short sellers that can mess up things, obviously, for many various things, including short squeeze and things like that, right? You got the options market, which that's a whole other can of worms out there. So yeah, he makes a good point, but it just doesn't work as perfect as he described there, although it might make sense.
Idea that at least now you have a debate, perhaps, in the room. You got a hawkish Harker and a dovish Daly in the last 24 hours, all sort of making their cases on where they see policy perhaps going from here. So it's no longer a one-way road. Does that factor into anything that if I told you, okay, 75 next month, 50 in December, and then we'll see, that doesn't change your view at all?
It doesn't change my view at all, because as soon as we get the relief that they've reached the 4.75 or the 5%, wherever they think the terminal rate needs to be, we're likely to stay there for a while, Scott. Remember, the thing that's going to make them pivot, we need to see one of three things. We either need to see the labor market approach 5% unemployment. We need to see a major contraction in the economy, which we haven't seen yet. So I'm talking about 3% or north of that. Or we need to see inflation come down by about 200 basis points. We haven't seen any of those things happen. And so we can't even begin to think about a true pivot, which would be cutting rates, until we start to see some traction on one of those three things. And we just haven't seen it yet. So we'll just remain in a... Go ahead.
But maybe a pause is enough.
Wow.
Maybe just a
Lucid down to $13. I didn't realize it had fallen that much. Wow.
pause is fine. We don't need a pivot.
I think a pause will be fine in the short term, and then we'll get another head fake rally like we got in July, like we got 3 weeks ago, and like we're seeing right now. At the end of the day, yes, it will bring a sentiment relief, and then we'll start to pull our pencils out and do the actual work and forecast what those heightened interest rates mean for consumption, what those heightened interest rates mean for the growth in the economy and the growth of corporate earnings.
So tell me then how you see next week. Tell me how you see next week shaping up with, these critical earnings ahead, big tech, make or break?
I don't think it's make or break, but I think on masse, the news will be more disappointing than I think people are expecting right now. Remember, we have some of the few safe havens that I saw in equity land reporting next week, and I expect some of those reports to be disappointing. Remember, cloud was something that I have always articulated as a safe haven, given the constant, consistent growth that we're seeing, given relative insulation from the inflationary pressures, and given the margin expansion that they've been able to continue to show. However, what throws a kink into that thinking is if we have decreased consumption and decreased IT spending, that will make growth decelerate even a little faster than I anticipated. So I think they'll come in line, but they will talk very worrisome about the coming quarters, I believe. I think we'll see the same thing in digital advertising, aside from search. I think we'll see the same thing in...
All right, so, first off, I like him, and I like a lot of the points he brings up there. It definitely sounds like he's bearish on the market over the next, I would say, 6 to 12 months. He didn't mention that specific time frame. Just judging off of his commentary, right? Now, this week, I think, could be... If I had to predict, I would think maybe potentially a down week for the market this coming week with all the earnings. And I'll probably do a full earnings video on the main channel and dive all very deep into that. Probably a down week. I think big tech wants to probably send a message to the Fed. This is just my personal opinion, maybe a little conspiracy theorist. I think, since almost all of them are reporting this week, I think they want to send a message to the Fed. I think they're going to try to come out and talk as negatively as possible about the state of the economy, about their feelings going forward, the levels of uncertainty. And I think they're going to try to, give the Fed, because the Fed, if you're talking about them paying attention to earnings season, the main ones they're going to pay attention to, guess what? So the biggest of the big companies. And most of those biggest of big companies, the Apples, the Amazons, Metas, all those sorts of companies are reporting this week. week, right? So I think if anything, they might all try to come out and be a little on the scarier side, very conservative. Then they set up their expectations for extremely low for 2023, for the fourth quarter of 22 and for all of 2023, right? Then expectations are very low. So then as a management team, you have your lowered expectations because you talked all scary and now people are all concerned, right? So that leads you into a good situation too. You can potentially scare the Fed as well into maybe not being as aggressive come the December rate hike and maybe going into a pause in 23 as well. Now that might not work because a lot of that depends on how inflation numbers come in as well, but they could at least try. Right? It doesn't hurt to try in life, and they might definitely try to do that, okay? All right, next one up, 2-minute drill. Microsoft, Apple, McDonald's, Coca-Cola, and UPS. How are their earnings going to be? Let's hear it.
Victoria Fernandez, half of her biggest holdings report next week. So it's all on the line. Nervous going in?
Not too nervous. I mean, look, Scott, we've had a pretty decent earnings season so far. We've been beating expectations for a lot of these companies. And I think some of these names have been beaten down so much. It doesn't mean they can't go more. I mean, we saw that with Snap, but they have been beaten down so much. I think they'll have decent earnings and maybe we get a little bit of a bounce.
Let's take them in groups.
She's got a little Texas accent. Is that Texas I'm hearing? You guys might be better at accents than me. Maybe a little down south, but it really sounds like Texas to me.
Microsoft, confident or concerned?
Yeah, I think maybe I lay somewhere in the middle, and I know that's probably not the answer you want to hear, but look, it's coming down to, it was really poor earnings or poor reporting last quarter for Microsoft when it comes to Azure. We want to see that do better. Ad business, obviously, we just mentioned Snap. That could give some concern for the ad business here. We want to see that go better, and we want to get an update on the Activision Blizzard and how it relates to their gaming and what we're going to see there. So I think there's components as a longer-term holding. Both Microsoft and Apple are both longer-term holdings. Apple is a demand story. It purely comes down to the strength of the consumer, the pricing power of Apple, seeing the level of base devices continue to grow broadly across all their products. Those are the things we're looking for.
So I'm not personally a shareholder of Microsoft or Apple, but I got to say, if you had to ask me who am I more confident in 2023 for numbers, it would be Microsoft. Microsoft has one of those beautiful business models that, people just have to stay signed up for their products, right? And many of their services might be just okay, right? But at the end of the day, they got that suite of products and companies stay signed up for it, businesses stay signed up for it. And that's their core business, right? And then obviously their cloud's a massive business. That's just a consistent growth engine for the company, right? Then they have obviously the Activision Blizzard kind of movement there. COD, I think, is going to do amazing over this next year as far as sales for that. I think it's going to be wild. So I think there's a lot going for Microsoft where I'm pretty confident in them in 23, regardless of the economy. I don't care if we're having a recession, an okay economy, a great economy, anything in there, right? I think they're going to be fine. Apple, I do have concerns about. Apple is still a business that's very dependent upon hardware sales, as much as their services has grown and become a bigger component of their business, right? They're still very hardware driven, and I do have some concerns about iPhone sales for 2023. I definitely do. And also I do think there's been a lot of pull forward on iPad demand and obviously Mac demand in 2020 and 2021 as well, and into the front part of kind of 22 as well. So those are my concerns. So if you ask me who I'm more confident in, for those reasons, I'm more confident in Microsoft for 2023 than Apple.
Coca-Cola and McDonald's too. Expectations there are what?
Yeah, again, we're talking about a consumer. And when you've got a labor market that is as strong as it is, and you have corporate balance sheets that are pretty decent, that's going to be support for the consumer. So I think you're going to see something like a McDonald's where they've had good same-store sales over the last couple of quarters. They're going to continue to do well. Obviously, when you look at Coca-Cola, PepsiCo had really strong quarter. Their demand was solid. There's pricing power there again, and you've got dividends for these names that helps with the stock. So I think we'll see pretty good earnings coming out of these names.
All right, 15 seconds.
So bad thing for McDonald's, and I was actually talking with somebody tonight about this. This gentleman actually owns some quick service restaurants in California, and what he was talking about is, minimum wage going up to $22 an hour. Whew. I mean, restaurant business is already a very low margin business. Anybody that's from the restaurant industry, you know that, right? Very low margin business. And I think that's going to hurt, obviously, companies like McDonald's and Starbucks, right? And that's not the only state that's going up, right? And McDonald's has a massive business in California, as does Starbucks and many other big, let's call it fast food companies or quick service restaurants like a Chipotle and those others, right? So I think that could definitely hurt margins. Those businesses have already been hurt tremendously by the cost of everything going up, right? And eventually people get priced out. I mean, I went to Chick-fil-A for dinner tonight. I got my, the family Chick-fil-A, right? $52? I've spent $52 at Chick-fil-A. I had to think to myself, I'm like, is that price right? $52? Like, I got 3 little kids, not big kids, little kids, and my wife and me, and I'm like, $52? What? Who flipped my flapjacks? I'll just go home and make flapjacks for $52. You gotta be kidding me, okay? It used to be $52. You'd go out and have a, decent dinner, like out to eat at a restaurant. Now it's $52 for Chick-fil-A for dinner. What in the world's going on, right?
PS reports you own it after FedEx. How do you feel?
Yeah, I think they're two different stories. UPS changed its business model during COVID. They focused more on that small and medium business, and their revenue per piece was up significantly. We want to see that happen again here in this fourth quarter.
We will leave it there.
So UPS, very in line with the market. And I got to say, they have, it has seemed like, been running their business better than FedEx. So take that for what it is. I've always been interested in, building a position in either UPS or FedEx. I would love to build a nice size position in the dividend account for one of those two stocks. But it seems like UPS is winning that battle right now, okay? Now, there's a very important video here. The Fed will communicate a pause in hikes in November, says Joe Terranova. That has big ramifications for the market.
Today, the 10-year is at 421. The 2-year is at 447. Remember, we were pushing like 460. So we're getting a bit of a relief, Joe. Maybe it's due in part to that Timuro story in the Journal on the idea of 75 in November, whether the Fed will do 50 then in December, and how they will communicate that. The market reacted to that story.
Without question, that's what the expectation has been. Will they give us some form of guidance at the November meeting that the unprecedented 75 basis point rate hikes of the past several months are coming to an end? And the market will respond positively to that. But to your point, Scott, we are completely hostage to where Treasury yields are going to go.
All right, first off, very important, okay? There's a real possibility that it will already be priced into the market. When the Fed does pivot, or let's say go from 75 basis points to 50 basis points, 25 basis points, are saying, hey, we're pausing now, whatever that situation is, right? It's very possible that the market doesn't move up in any substantial way because the market has already expected that and it's already moved up prior to that, okay? Remember, the market's trying to time these things out before. Why does the market start to bounce back so much already, even though people said we're supposed to have a November-December rally? Why does the market start to come back so strong already in October? Well, because everybody's talking about November-December rally, so guess what? People think, I'm going to get in before November, December, right? And then they can bid it up for me as we get into November and December, right? So that's the thought process. Everybody wants to be first. And if you're taught anything in the financial markets, a lot of it's about either being smarter, right? Or being first. Or cheating. That's the other part, right? It's one of those three usually in the situation, right? So if you're not cheating the market, right, then you better be first, you better be smarter. A lot of times, guess what? It pays to be first, and not necessarily going to be always the smartest person, but if you're the first person, it's pretty big.
463 earlier today for a 2-year Treasury. And I can tell you, I've spoken in the last 2 days with several taxable fixed income money managers who are telling me that there are liquidity concerns in the Treasury market and in the high yield market. It's real. It's in the wake of the events over in the UK, and it's something that I think the Federal Reserve and the Treasury Secretary have to pay attention.
All right, so your points are well made, and I think well taken. So yeah, I think we are in large part held hostage in some respects, Surat, by the move in interest rates. You've seen the correlation directly, rates up, stocks down. As Joe was saying that, though, then I'm thinking, well, maybe the Fed is held hostage too.
Yes.
Because they can't allow rates to get out of control either. And that's what Nat Alliance is talking about today.
10-year yield hits fresh 14-year high. Jeez. Can't be like that forever, but it is like that right now.
To the report in the Journal, they say
and those babies can move the 30-year mortgage around too. Ugh.
Seems like the Fed, regardless of what they say, does not want rates, especially the long end, to get.
You didn't get to watch the video I put out earlier today on this channel. Definitely check out that one. That one was diving into essentially a situation where this gentleman believes that mortgage rates are going to be 10% plus in February, which is huge.
Control. We think we're on the verge of a taper tantrum. Maybe we had it from 410 on the 10-year to 434 too far too fast.
Yeah, look, I think it's not just the interest rates that they're doing. It's what are the ramifications of this? And, we saw what happened in Europe and the UK. Could that explode into a credit issue? Also, when you think about all our debt that we're issuing, how much can the government support at those rates? So I think, this lagged economic data, the faster it comes, and if it's actually going to, complement what the Fed is doing, then I do think it doesn't necessarily mean we're going to get the Fed pivot to cut. But if we actually get some signaling that this is where we're going to be and we're going to stay here for a while, I think the markets will like that uncertainty taken away.
I'll tell you what the market is liking right now, and it was Carl Quintanilla in the handoff to our show who noted those comments from Mary Daly, who says we're at or close to a neutral rate, which is interesting if you think about the trajectory of where we're going from here. It's no surprise that you've got a 500-point gain now on the Dow. She also says all of this sort of requires a step down into smaller increments of hikes. It's kind of exactly what we're talking about and why some are remaining bullish here, because they think the Fed is close to the end and they're going to make it clear at some point soon that they're close to the end.
So real quick, I think what the Treasury market has done with the rise in yields is no longer does the Federal Reserve, Scott, have the luxury of waiting to see if the rate hikes, the tightening of the balance sheet, will bring down inflation. The market is telling them they can't wait any longer, and I think that is crystal clear right now, and that's why I think you will get a pause, and it'll be communicated in November.
Yeah, I think that's big. When we get that pause, I think it's going to be big, obviously, for the market. It's just, I think there's definitely a possibility that much of it could already be priced into the market. Market's always forward-looking in these situations, so don't be surprised if, when that actually happens, you don't get that big of a move because it's already been priced in at that point in time. Never mind if you get a big, continued rally for the next, let's say, 1 to 1.5 months, if not 2 months. It's going to likely already be priced in at that moment, right? And then it's going to go back to kind of earnings and what's happening with actually companies and what's happening with the underlying economy at that point. Hope you guys enjoyed this video. As always, thank you so much for everybody that subscribed to the channel. We are now 17,000 plus subscribers strong. If you're looking to join my private stock group and get access to everything in there, including the private Discord chat, our weekly investor report, as well as all my different course curriculums teaching so many different subjects in the markets, check out pinned comment down there. Much love and have a great day.